The price to EBITDA, P over EBITDA ratio explained. The price to EBITDA, P EBITDA ratio is a valuation metric that compares a company's market capitalization, or enterprise value, to its earnings before interest, taxes, depreciation, and amortization, EBITDA. It's used to assess the relative value of a company, especially when comparing it to other companies in the same industry. What does it measure? The P over EBITDA ratio indicates how many dollars an investor is paying for each dollar of a company's EBITDA. It's often favored over the price to earnings PE ratio because EBITDA is considered a better measure of a company's operating cash flow, as it excludes the effects of accounting and financing decisions, interest, taxes, depreciation, and amortization. It allows for easier comparisons between companies with different debt levels, tax rates, and depreciation policies. Why is it used? Valuation. To determine if a company is overvalued or undervalued compared to its peers. Comparison. To compare companies within the same industry regardless of their capital structure or accounting practices. Acquisition target assessment. To assess the attractiveness of a company as a potential acquisition target. How to calculate the P over EBITDA ratio. There are two primary ways to calculate the P/EBITDA ratio, depending on whether you're using market capitalization or enterprise value. 1. Using market capitalization, formula P over EBITDA equals market capitalization over EBITDA. Market capitalization, share price x number of outstanding shares. You can typically find this information on financial websites or the company's investor relations page. EBITDA, earnings before interest, taxes, depreciation, and amortization. This can be found in the company's income statement. Sometimes it's listed directly as EBITDA, but if not, you'll need to calculate it. EBITDA equals net income plus interest expense plus taxes plus depreciation and amortization. 2. Using enterprise value, formula P over EBITDA equals enterprise value, EV over EBITDA, enterprise value, EV, market capitalization plus total debt minus cash and cash equivalents. EV represents the total cost to acquire the company. EBITDA. As described above, find it or calculate it from the income statement. Which method to use? Market capitalization over EBITDA. Simpler to calculate and use when comparing companies with relatively similar capital structures. Enterprise value, EBITDA. More appropriate when comparing companies with significantly different levels of debt and cash, as it takes those factors into account. EV/EBITDA is generally the preferred metric. Analyzing the P to EBITDA ratio, lower ratio, generally indicates undervaluation. A lower P/EBITDA ratio suggests the company may be undervalued because you are paying less for each dollar of EBITDA. Higher ratio generally indicates overvaluation. A higher P/EBITDA ratio suggests the company may be overvalued as investors are paying more for each dollar of EBITDA. Important considerations. Industry comparisons. The P/EBITDA ratio should primarily be used to compare companies within the same industry. Different industries have different growth rates, capital intensity, and profitability, which can significantly affect their P to EBITDA ratios. Growth rate. High growth companies often have higher P/EBITDA ratios because investors are willing to pay a premium for their future earnings potential. Profitability. Companies with higher profit margins and more consistent earnings tend to have higher P/EBITDA ratios. Debt levels. Companies with high debt levels might appear to have lower P to EBITDA ratios when using market capitalization. Enterprise value helps to account for this, which is why EV/EBITDA is often preferred. Qualitative factors. P over EBITDA is just one metric and shouldn't be used in isolation. Always consider other factors like management quality, competitive advantages, and industry trends. Example, comparing two companies. Let's say we want to compare two software companies, TechCo and SoftCorp. Metric TechCo versus SoftCorp. Market capitalization, $1 billion versus $1.5 billion. Total debt, $200 million versus $500 million. Cash, $100 million versus $200 million. EBITDA, $200 million versus $300 million. Calculations, TechCo, EV equals $1 billion plus $200 million minus $100 million equals $1,100 million. EV over EBITDA equals $1,100 million over $200 million equals 5.5. SoftCorp, enterprise value equals $1,500 million plus $500 million minus $200 million equals $1,800 million. EV over EBITDA equals $1,800 million divided by $300 million equals 6.0. Analysis. Based on EV over EBITDA, TechCo has a lower ratio of 5.5 compared to SoftCorp's 6.0. This suggests that TechCo might be relatively undervalued compared to SoftCorp. However, further analysis is crucial. We need to consider growth rates. Is TechCo growing faster or slower than SoftCorp? If TechCo is growing faster, a slightly lower ratio may be justified. Profit margins. Does TechCo have higher or lower profit margins? Higher margins could justify a higher valuation. Competitive landscape. Are there any specific industry factors affecting the valuations? Debt levels. SoftCorp has higher debt levels, which is captured in the enterprise value calculation. Conclusion. The P/E/B/I/T/D/A ratio is a useful tool for comparing companies and assessing their relative valuation. However, it's essential to use it in conjunction with other financial metrics and qualitative analysis to make informed investment decisions. Don't rely on P/E/B/I/T/D/A alone. Consider the bigger picture. Follow vpcontroller.com for more content like this.